Hey, SD here. I'm trying to do a short video, trying to make it concise. I'm going to talk about a trade here and about trading with a trend, and the trade was made with Apple. And it was an early trade going long when price was downtrending, and I think it's critical to understand from my point of view. I think we have better success when we wait and we trade with the trend. We have less chance of getting caught in a bad trade with price drops lower on us, and we end up becoming long-term investors as opposed to short-term traders. I'm an end-of-day trader, so I trade and set my trades up after seeing what the price action was at the close of the day. So some of what I'm saying may or may not apply to some of you out there, but I wanted to use this as an example. So the trade was set up. Apple, let's look at this. This is a 2-hour chart. We can see that Apple had been moving up over here in the month of August, started going up, went into a sideways consolidation here. This sideways consolidation lasted for weeks on end. Tried to make a little higher move back over here, had a sell bar here, and very quickly Apple, this whole area from the 490 range, 485, all of a sudden it gapped right on down, and Apple opened up here way down back here at this what could be called a minor support level at what had been a previous price consolidation for a little bit before it had moved higher in the uptrend. When price was at this level here, if you look, price is below the moving average, and this is a fast moving average on the 2-hour chart. The same would be true whether this was a daily chart or a weekly chart. If price is below the moving average and the moving average is heading down, then you can consider that you're downtrending, and you want to take trades generally with the trend, not fight the trend. In this case, we'd want to make a trade long only when we see a reversal of trend attempt occur. So placing a limit order to buy here below a breakdown of this price level got a lower price, certainly got a lower entry than this price level, but that was on a resumption of the downtrend, so it could have been very dangerous. As it was, Apple closed for all 4 bars that day, closed lower, and it closed down here about 10 points lower at the 450 range. Then there was a reversal bar which came the next day, but that was not based on any definitive level of price action. In other words, this reversal, there's no real support at this level right here for price. It could have just as easily continued lower, going on down further for several days more. Price made the reversal, so if I was watching Apple and I had wanted to make this trade, I would have waited to have seen a reversal trying to ensue like this, and then I would have wanted to have placed a buy stop order to go long back above this gap down sell bar right here that occurred. Yes, that would not have gotten me in early. It means waiting for a little bit to take the trade long in my direction, but I want to see proof in the pudding. I want to see that price is actually making an effort to head higher, and so I would have taken the trade long here. Now, had I done so, price then gapped up, looked like it was trying to go even higher, looks good, the trade looked good, and then Friday it started to close with market weakness. The entire market was weak on Friday. This started to close down lower, and it essentially is filling the gap back here of this little price range breakout at the 465 area. My stop entry, once price had moved up here, I would have had a stop up here at the 460 level. And let's assume I entered, let's say I got filled at the high here. Then with this price action, I would probably leave my stop right here at the 460 level, believing that, okay, price may fill the gap, but let's give it the chance to move higher. So I would be a holder here at 460 with the stop loss. If I get hit, it would not be bad. $5 on a $460 stock, that's less than 1%. That's not a bad risk to potential reward. Anyways, that's kind of the way I look at the charts. Going to flip back over, look at the daily chart, for example, and on the daily, the same trade, the same setup, illustrates the same. Apple up, Apple consolidating sideways. The break of that consolidation lower means price is downtrending, price is below the moving average. This is dangerous to be jumping in here and entering below this on a continuation of what was the downtrending move that was starting to occur. So this could be dangerous. There's nothing here to hold this price action from not going any lower. So if we look to the left, we've got no real support for price to bounce off of. The fact that price did move up higher here was just coincidental and lucky for the trade, I think. All right, we step back out to the weekly chart. Knowing what the trend is on the larger time frame that one trades is often very helpful. In this case, when we look at the trend here, we do see that there is prior support potentially at this 459 level. So price came down. Our fill got filled. Our trade rather got filled on this bar here as price was moving down. And then we had a penetration of the support. Price closed back up higher. We'll have to see if this has any meaning to it, if it will hold or lead to anything further. So right now, technically, what I would try to illustrate would be know what the daily chart is telling you, but also know what the weekly chart is telling you if that's the way you want to trade. You can trade on the daily, but look at the weekly, understand what price action is doing and where it sits in relation to everything else that came before it. All right. This is SD, and it's just my opinion, my 2 bits I'm throwing out here, trying to be constructive, sharing my point of view and how I would approach trading with the trend. Thanks.